Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. Please note that the views shared here are not personalized financial advice and are for informational purposes only. Always consult with a financial professional before making any investment decisions. Now let's dive in. So if you just looked at the stock market today, you'd think everything was, well, fantastic. We were firmly back in a Goldilocks environment.
Oh, absolutely. U.S. equities had a huge relief rally, snapping that multi-day sell-off we've been watching.
But if you just glanced over at, say, the crypto markets, or even currencies, you would get a completely different story.
You'd think the financial world was melting down. It really wasn't a simple rally today. It was more like a fracture.
A fracture, that's a good word for it. It's like we saw three major asset classes all following completely different roles.
It was a fascinating and frankly confusing day. For stocks, the news was great. The S&P 500 up almost a full percent, 0.98 to 6,602.899.
And the Dow gained, what, over 1%?
1.08%. Added over 493 points. The Nasdaq was up strong to 0.88%. It was a really widespread, enthusiastic move back into risk.
And it was all driven by, well, it wasn't a piece of data, it was one person.
One person. A handful of very carefully chosen, very dovish words from New York Fed President John Williams.
Right, and his comments just instantly changed the entire mood.
They did. He gave the clearest signal we've had in weeks that the thinking inside the Fed might be softening. He said he sees policy as, and I'm quoting here, modestly restrictive, although somewhat less so than before our recent actions.
Okay, that's interesting, but what was the real kicker?
The real kicker for the market was this line. He suggested there's room for a further adjustment in the near term.
Room for a further adjustment? I mean, that's just Fed speak for we might be cutting rates sooner than you all think.
Exactly. And the market heard that loud and clear.
So what was the immediate fallout from that?
The repricing was instantaneous. Fed funds futures, which measure the odds of a rate move, they soared. They went from pricing less than a 40% chance of a December rate cut to over 70%.
Wow. That is a massive jump based on just one person's comments.
It tells you just how starved the market was for any kind of dovish signal.
And of course, when rate cut odds jump like that, the bond market is the first to react.
First and fastest. We saw Treasury yields drop sharply, which of course means bond prices went up. The 10-year yield fell over 3 basis points to 4.065%.
The 2-year, which is super sensitive to Fed policy.
That dropped even more, over 4 basis points down to 3.516%.
Yeah.
And for anyone listening, a basis point is just 1/100 of a percent. So these are significant moves.
So you have stocks rallying, bonds rallying. That's the classic Goldilocks pattern. It implies the market thinks the Fed is cutting because they can't. Inflation's cooling, not because they must like the economy's collapsing.
That's the narrative that drove stocks today for sure. But, let's pump the brakes a little on that optimism. We have to remember this 70% probability is built on one man's comments. And it kind of contradicts what we've heard from Fed Chair Powell, who said a cut is far from a foregone conclusion.
Right, and we still have others like Dallas Fed President Logan who are still sounding very hawkish.
Exactly. So the market is sort of choosing to hear the good news and ignore the cautionary signals. It's pricing in a certainty that the FOMC itself has not agreed on.
Which is a perfect setup for volatility. And this is where the story, as you said, fractures. Because if stocks and bonds were celebrating Goldilocks, then what on earth happened in the crypto market?
It was a biblical catastrophe. That is not an exaggeration.
The divergence is just staggering. Give us the numbers on that collapse.
I mean, the scale was enormous and violent. Bitcoin plunged below 85,000, briefly touched 81,600. That's a 10.4% drop in 24 hours.
And that puts the monthly drop at
23%. It's the worst drawdown since the deep bear market of June 2022. Ethereum fell over 11% too. It wasn't spared.
That doesn't sound like a rational repricing. It sounds more mechanical.
It was a vicious cycle of forced deleveraging. You had nearly $2 billion in liquidations, wiping out almost 400,000 traders.
$2 billion. And most of that was from people betting the price would go up.
Yeah, that's the crucial part. $1.78 billion of that was from long positions. So when you have a market that over-leveraged, even a small dip can trigger these massive margin calls, forcing sales, and it just snowballs.
Which is why the analysis is calling this an idiosyncratic collapse. It's not a signal of broad financial risk. It's a crypto-specific problem.
That's the consensus, yeah. I mean, if this were a true systemic risk-off event, the S&P would have been down hard, the VIX would have been soaring. But we have to talk about the institutional signal here,
ETFs.
the ETFs. U.S.-listed Bitcoin ETFs saw $900 million in net outflows on Thursday alone.
900 million in one day.
And that brings the 3-week total outflow to over $2.64 billion. When the institutional money that helped legitimize the whole thing starts running for the exits like that.
It tells you the sentiment story in that space is completely broken.
It is. The Crypto Fear and Greed Index confirms it. It collapsed to a reading of 11.
11. And anything below 25 is extreme fear.
Exactly. 11 is the lowest we've seen since late 2022. It is maximum despair, total disconnected from the mood in equities.
Okay, let's move to the third fracture, and maybe the most confusing one, the US dollar. If the Fed is signaling cuts, the dollar should be getting weaker.
It should be.
But the dollar index, the DXY, actually rose today, up 0.18% to 100.34. Why is the dollar defying gravity?
This is the critical thing for you to watch right now. The normal relationship is, U.S. yields fall, rate cut odds go up, the dollar gets weaker.
Because there's less of an advantage to holding dollars.
Right. The fact that the dollar got stronger today while yields were falling suggests there are some really powerful non-monetary forces at play.
Okay, so what are those forces? If it's not about interest rates, what is it?
I think there are 2, maybe 3 big ones. First is just relative economic strength. The U.S. economy, for all its mixed signals, is still outperforming Europe and Japan pretty clearly. Money follows growth.
And the second would be safe haven flows.
Safe haven flows, exactly. Even with stocks rallying, there's enough nervousness out there from the crypto meltdown, from AI valuation concerns, that people are still parking cash in the world's most secure asset, the dollar.
And the third factor is a bit more complex. It has to do with Japan.
It does.
Sure.
Japan's own long-term yields have been surging. This can actually force a kind of global liquidity tightness. You might see big Japanese institutions who own tons of U.S. assets start selling them to bring that capital back home.
And that process involves selling foreign assets, but ultimately buying dollars and yen, which supports the dollar structurally.
It creates this powerful structural demand for the dollar that can just overwhelm the dovish chatter from one Fed president for a day.
So the dollar's strength is telling us that global money flows are still tightening, even if the Fed is thinking about easing.
That's the takeaway. And you see that caution reinforced in the commodity markets, too.
Right. WTI crude was down.
Down 1.9% to 57.89. Gold was also down, which is interesting.
Yeah, gold should rally on easing hopes, so the fact that it fell...
It tells you the dollar strength was the dominant force today. But, inside the energy complex, you have this massive counter trade going on.
Natural gas?
Natural gas is on an absolute tear. While crude oil is falling, nat gas is up 52% over the past month. It hit $4.55 per MMBtu today.
And that's all about strong LNG exports and cold weather forecasts.
That's it. A purely fundamental story of high demand driving that market completely opposite to crude.
Okay, let's shift back to equities for a minute. Looking inside the rally today, since the catalyst was lower rates, did we see the rate-sensitive sectors lead the charge?
We absolutely did. It aligns perfectly with the story.
Yeah.
We saw leadership from names in consumer discretionary. Think Home Depot, Starbucks, McDonald's.
That makes sense. Lower rates are good for borrowing costs and, in theory, for the consumer.
Exactly. And we also have to mention a huge milestone in healthcare.
Eli Lilly.
Eli Lilly hit a $1 trillion market capitalization. They joined that very, very elite club, mostly on the back of their GLP-1 drugs for weight loss.
Right.
It's a huge validation of their lead in that space.
Now, the big contradiction in tech this week. Nvidia. They delivered phenomenal results, amazing guidance, 65% growth, a $500 billion order backlog.
Staggering numbers.
And yet the stock reversed hard on Thursday and was weak again today. What is that disconnect telling us about the whole AI trade?
Look, this is probably the most important microsignal of the week. When a company guides for 65% growth and the stock still closes down, it means the market has moved past the AI at any cost phase.
The valuation just already baked in all that good news?
It baked it all in and then some. The focus is shifting now from how fast can you grow to how much does it cost to sustain that growth. The capital intensity required to build all this AI infrastructure is enormous. and investors are starting to ask tougher questions about profitability.
And even with the rally today, overall anxiety, as measured by the VIX, is still really high.
It is. The VIX closed around 26.42. I mean, anything over 20 signals caution, and it's still up 50% in November alone.
So near-term turbulence is not going away.
Not at all. Now, historically, VIX spikes like this often lead to better returns 6 to 12 months out. But for now, it means buckle up.
And technically, the S&P 500 did manage to hold an important level today.
Yes. It decisively held its 50-day moving average, which is around 6,660. That's the good news. The bad news is it's still below its 100-day moving average for the first time since May. So that 50-day is the current battleground.
But the big structural risk that analysts keep pointing to is concentration.
And it's a risk every investor needs to be aware of. The top 10 stocks in the S&P 500 still account for over 40% of the entire index's value.
40.5%.
Which means the health of the whole market is disproportionately riding on just a tiny handful of mega-cap names. If one or two of those falter, like we sort of saw with Nvidia's reversal, the whole index feels it.
And there's a big warning signal coming from the credit markets that seems to confirm that structural concern.
This is a huge and often overlooked data point. Corporate credit spreads, basically the extra yield you get for taking on corporate risk versus safe government debt, have blown out.
From what to what?
They've gone from about 75 basis points in late October to around 120 basis points now.
That's a 60% jump in the risk premium in just a couple of weeks.
It is. And credit markets tend to lead equity markets. When those investors who are very focused on risk suddenly demand 60% more compensation, they're pricing in a slowdown or a risk that stock investors, at least today, are choosing to ignore.
Let's touch on real estate quickly. It should be the main beneficiary of lower yields.
And mortgage rates are definitely getting some relief. They're their best levels of 2025. You can find a 30-year fixed around 6.12% to 6.26%.
Which is a big improvement from the start of the year.
Almost 100 basis points down from the January peaks. But sales activity is still just stuck in the mud.
Because of high prices and the rate lock-in effect.
Exactly. No one with a 3% mortgage wants to sell their house to buy a new one at 6%. It's crushed turnover. We're at the lowest turnover rate in at least 30 years. Only 2.8% of homes changed hands in 2025.
Okay, so bringing it all together. The market is now completely fixated on the December FOMC meeting.
December 9th and 10th. That's the next big hurdle. And while the market is pricing in that 70% chance of a cut, there's a huge catch.
Which is?
The key November inflation data, the CPI report, it gets released after the Fed meeting is over. So they'll be making this massive decision with incomplete data.
Which just adds another layer of risk to that 70% probability the market's priced in.
A huge layer of risk.
So we've got this split market. Goldilocks in stocks and bonds, but a liquidity crunch in crypto and the dollar. What's the one thing you're watching next week to see which narrative wins?
It has to be the U.S. dollar. The dollar's strength today, in the face of a dovish Fed signal, tells me that these bigger, non-monetary capital flows are in the driver's seat. If the dollar weakens next week, it means the Goldilocks story is taking over.
But if it stays strong or gets even stronger,
then you have to be very concerned that the liquidity crunch thesis and the warning from the credit markets is the real story. That's where all the focus should be. That's all for today's episode of the Daily Consolidation. If you enjoyed our analysis, remember to like this video and subscribe to our channel for more daily market briefings. See you at the next close.